Hey, what's going on, everyone? IGTV, YouTube, welcome to the Credit Plug channel, where we talk about how to build primary accounts, how to get you access to high limit credit funding, and how to establish relationships with financial institutions. Now, this video is going to be revolving around the concept of relationship banking, and that's one of the most effective ways of establishing a relationship with a bank, as well as getting access to credit, loans, and other financial products, even if you don't have necessarily an excellent 700 plus credit score. So I made a couple videos about this previously, and the reason why is because I think oftentimes there's a misconception about how to go about getting credit funding, and generally, we're sort of taught to believe that it's only about your credit score. So that is true. Your credit score is definitely important, especially with obtaining loans and credit cards and things like that. But there are other ways for you to get funding and build a relationship, even if you don't have, let's say, 750, 720 credit score. And even in that same light, just because you have a high credit score doesn't mean that you're going to get whatever type of funding that you apply for, because there's a difference between your credit score and underwriting. So underwriting, looks at your actual primary accounts, looks at your age of history, looks at your payment history. So sometimes there could be, and I've had clients like this as well, who they have a relatively new credit profile, and they might add a couple of trade lines, a couple authorized user trade lines, and get up to like a 720, 730, but they don't have any primary accounts of their own. So, and that particular profile won't necessarily get high limit credit funding, because they haven't yet demonstrated that they can handle that type of debt load as a primary account. So you just have to understand the differences between your credit score versus the information that's actually used when underwriting a particular loan or financial product, credit card, etc. So that's one little distinction. So just because you have a high credit score, you have to look at your entire profile. And even, let's say, if you have let's say fair credit, you have 670, 660, something like that, but you have a history of payments and different primary accounts where you've been able to demonstrate you can handle certain debt loads, then that doesn't necessarily disqualify you from being able to get funded, especially, and this is what this whole video is really about, especially if you have a relationship with a particular financial institution. And so one of the most effective strategies is, actually having deposits at a particular institution. You can use your excess cash reserves to build a relationship. And here's how. So generally, let's say you are in this particular category of individual or consumer where, you might have, let's say, a credit score anywhere from like 640 to a 680, per se. And, you have a good job, you make good money, steady income, but you may have one or two things that may be dragging down, your credit score, maybe student loans, maybe, a collection or mispayment or something like that. But other than that, you have, pretty good steady income, and you might even have, 10, 15, 20, $30,000, between your checking and savings account. So one way that you could utilize, your excess cash reserves is, just by having that money sit in an institution, whether that's, your checking account, your savings account, you could have retirement accounts, 401ks, IRAs, even CDs. So all of that, all of those different relationships, are taken into consideration with certain institutions that value value the relationship. So that's called relationship banking, where you have multiple different accounts within the same institution, and so the institutions view you as a higher value customer because they're providing services to you, or they're providing products to you across different business lines. And another thing about this too, you have to remember that banks and financial institutions benefit from you having your money sit in their banks, because what they do, all the money that's in deposits, the bank's lending out. So the more money that you have deposited, it increases the bank's lending capacity. And this is a concept known as fractional reserve lending. So basically, and the law just changed, but just for demonstrate, or just to give you an example. So for like every $100 that you deposit, you're increasing the bank's lending capacity by $1,000. And like I said, that's not precise, because they recently just even lowered it less than that. I think it's like 9.6. So whatever the outstanding loans are, the bank has to have like 9.6% of that as a reserve. And so, anyways, that counts. So having money in an institution definitely holds weight. And I talk a lot about this, especially with like secured cards. And actually, when you come to the table with money, you present yourself as a less risky customer. And so that's just one of the most effective ways of mitigating. And then when you have money that's sitting, and you have money, you have money, a pool of money sitting in a bank, and you have money coming in and coming out, the banks, they're collecting that data, like your average daily balance, your net your net, looking at inflows and outflows, and seeing, how much money is being retained in your account. And once you're able to demonstrate that, you don't necessarily, you're not using all the money that you have, and you have money that's sitting there that, you're not necessarily utilizing, and you're not really dependent on, as far as, utilizing all of that money, then that holds some weight with the banks, because they see, okay, you have this money sitting here, you're using it, the account has some activity, but you're not drawing down the majority of your money every month. So that to the bank shows that you have financial stability. When they're able to see a decent time span of you having deposits in their institution, and you're not necessarily drawing down the majority of it, right? Because at the end of the day, banks like to lend money to people who don't need it. And that's one thing that I learned, just working in portfolio servicing for SBA guaranteed programs. A lot of the borrowers, generally, they were, whatever amount that they requested, they generally had that as reserve, as collateral. So let's say if someone wanted to borrow, I don't know, like $100,000, generally they would have that and more as, liquid assets, whether that's in their bank account or, some other type of asset. So when you come to the table with money in the same ways you do with like secured cards, that's one way of establishing a relationship with a bank, especially if you don't have, let's say, 700 plus, but you might have fair credit and you have some cash reserves. You can utilize the relationship banking, and there's different methods of doing that. But basically, if you're able to expand your relationship across many different product lines within an institution, then they're going to value you much higher, so that when you do apply for, let's say, a credit card or a line of credit or a loan or something like that, they'll see, okay, hey, this individual, they have they have a savings account with us with 10,000. They got a checking account. We see the direct deposits that come into their account. They have retirements accounts and stuff like that. So you're viewed as more stable and less risky. So when you do apply, they'll say, okay, you might have a 660, 670, but you have all these other mitigating factors as well. And so that can be the difference between you being denied versus you being approved. All things equal, let's say someone with the same exact credit score as you, but you have all these different deposits and the other person doesn't, by their traditional underwriting guidelines as far as credit score, neither of you would necessarily meet that, but they might see, okay, you have all these deposits and this person doesn't, so this person's probably going to get denied, because not only do they not meet the credit credit criteria, but they have nothing else to help them look more favorable. Whereas you might have 25-30,000 in their bank, and even though you might be a little bit shy of what their credit criteria is, if they're doing a manual review of your loan application, oftentimes they can get that approval for you, because they see that you're you're lower risk, because you do have some cash reserves, and then you're already you're helping them because you have money in their bank, and at the end of the day, they don't want, their goal is to lend money out. And so when you demonstrate that you have a vested interest, and you have that cash basically in their bank, they're gonna give you some leeway. So that's one of the main strategies, I would say, if you're someone who you have a decent income, but your credit score might be a little bit shy of whatever the normal criteria is. You could definitely utilize that. And obviously this isn't going to be for everyone. I'm just saying, for those of you who have, I know there's a lot of people out there who have good paying jobs, good steady income, but like I said, they might have a couple things that are just dragging them down to where they wouldn't traditionally meet that credit score criteria. So in a nutshell, you can use your excess cash reserves, whatever your cash position is, to, in a sense, force a relationship with the financial institution and get access to credit funding, and then build from there. So my suggestion would be, if you're someone in that position, and there's a new institution that you want to go out for, just go and open up a savings account. Let that money sit there for a while, maybe borrow against that, and then just show a little track record of on-time payments. And then after let's say 3, 6, or even maybe 9 months later down the road, after they've collected some data on you, then you could try to go for an unsecured product, and see how that works. So that's all I wanted to share for this video. If you're interested in how to build primary accounts, you could email us info@creditplug, or visit our website at www.creditplug.com. Until next time, y'all take it easy, and we'll talk to you soon. Peace.